Good evening, everyone. Welcome to our Maryland Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. Thanks so much for taking time out of your busy schedules. I know Thursday nights can be a little hectic for everyone, so I'm glad you got a chance to spend some time with us. This is the first class that we're going to be doing this year for the Maryland Alumni Partnership. Really thrilled to be a corporate partner with Maryland, and we got a chance to be out at homecoming last year. Maybe you got a chance to stop by our booth, get a chance to get connected with us. But we're hosting classes like this 4 times a year for our partnership for alumni. These are resources and support that we help provide to our local communities in homeownership. And so this is a kind of a Maryland specific class, but wherever you're joining us from across the country, we're here to help support you. So we're going to hopefully give you some resources and just thoughts on homeownership. So whether you're thinking about buying this year, or maybe this is a 2 or 3 year goal, we want to help give you that support you need to make this really huge financial decision. So again, my name is Jason. I'm with a company called American Pacific Mortgage, and we're your corporate partner in mortgage with the University of Maryland alumni. I know we have guests that are joining us from all across the country, and we have a really well-attended class tonight. So I'm really excited to be able to present this content to you. If you get a chance, pop in the chat where you're joining us from, because I'm based out of California today, but it's always kind of cool to know where everybody's joining us from across the country. So if you can, just drop in the chat kind of where you're joining us from. I'd love to be able to kind of see where our audience is coming from tonight. We're going to talk about statistics in housing. Might not be specific just for Maryland. It can be nationwide statistics. So it's always kind of cool to, like I said, know where everybody's joining us from. Just so you can know a little bit more about American Pacific Mortgage. American Pacific Mortgage is a direct lender. We've been in business for almost 30 years. We're the top 10 lender in the entire country. So we have brick and mortar offices strategically placed across the country. But as you know, as businesses change for a lot of different businesses, not only just mortgage, but we do things primarily over video with clients. So whether we're in the Midwest or down south or on the East Coast or West Coast, we're here to help support you with your home buying needs. And in essence, what we do is we provide educational classes like this to help kind of guide the future home buyers to make sure you understand all your resources. And for those of you who got a chance to put your location in the chat, thank you so much. I got a lot of us from Maryland. So, okay, cool. Arizona, Connecticut, DC. All right. Okay, cool. Very cool. Virginia. So a lot of us from the DMV area. Okay. Very, very cool. I love to see that. It helps me really get a sense of where our audience is at. And when we go into some market data in just a little bit, a lot of what we see, especially from a housing perspective, is going to look very similar across most parts of the country. Okay. Now, tonight's class is going to be a very interactive session. So as I go through the presentation tonight, we'd encourage you to engage with us for questions. We'll go ahead and answer those questions on air. You've used the chat function in Zoom, but if you can use the Q&A function for any questions you have, I'll do my best to answer those on air. The workshop time runs about an hour, so we should have you wrapped up by the time we get to the top of the hour. We'll weave in those questions that come from our audience, but also carve out a little bit of time for Q&A at the end of tonight's class. And then finally, as we dive into our talking points, this class will be recorded tonight. We'll have the class up on our YouTube channel. So if you want to refer back to that at any time, or maybe share this with friends or family or maybe coworkers, they can come check out the recorded version. And all the presentation material will be sent out to you tomorrow morning. So you'll have that for your reference. Okay. Awesome. All right. Well, let's talk about what we're going to cover tonight. So we're going to spend some time looking at the housing market in just a bit. So all the chat that you guys gave me, that's great. We're going to spend some time also looking at interest rates and what's going on with today's interest rate market. We had a little bit of movement in a negative way when it comes to the market and interest rates today. And then we're going to look at a budgeting exercise in just a few minutes. I want to kind of walk you guys through what's it going to look like if I decide to rent and continue on my rent path versus what it could look like to own a home. Spend some time looking at credit, how that can impact buying for us, student loans, and how that is measured in home financing, different loan programs. We'll talk about some documentation that we want to get together. So if we're thinking about maybe being on that path towards home ownership, what are some of the financial documents I need to gather? We'll look at assistance programs that are available, not just in the DMV area, but across the nation. For your specific market, like I know we have one of our guests here from Arizona. State of Arizona has some very specific first-time buyer programs. We'll talk about kind of more national coverage, but we can kind of dive into localized first-time buyer programs as well. And then finally, we'll wrap up tonight's discussion looking at the process of owning a home. So after tonight's class, you may say, hey, you know what? I think I want to get connected with you guys and figure out what this might look like for me. We're going to take you down that milestone or the different milestones you're going to experience as a future home buyer. Okay. All right. Again, appreciate you guys joining us tonight, and let's go ahead and dive in. So when we think a little bit about home ownership, this is probably going to be one of the biggest investments you guys decide to make in your upcoming financial futures, right? It's a big deal. And we have a really large audience tonight, which is great because a lot of us are thinking about home ownership, and we want to get kind of our better understanding what this could look like for us, right? So when we think about home ownership, there's a lot of great benefits that come along with owning a home. You have the ability to create affordability, right? So you're not worried about your landlord increasing your rent. This home is an asset. So generally this asset will appreciate over time. As I owe less on my mortgage, my home goes up in value. That separation of those two numbers creates equity, right? Equity can create more wealth for us as that asset grows over time. And that as that asset grows and things change for us, we may have this as an asset to heirs of our estate. We can also leverage this as a potential tax advantage too. So there's a lot of good things that we got to think about when it comes to home buying. And what I encourage buyers to do is that when you're doing a budgeting exercise like we're going to do right now, don't think about home ownership as an apples to apples comparison to your rent payment, because there's a lot of ingredients that go into the benefits of owning a home. So we want to think about some of the upside opportunities that with owning, but I think it does start as kind of a baseline of what's it going to look like from a budgeting perspective for me. So our first stop in tonight's journey of our class is we're going to do a budgeting exercise together. I mentioned to you earlier that we're going to send all the presentation materials. So the link that I just jumped into, I'm going to send that out to you tomorrow morning, so you can do your own kind of exercise through it. But I thought I'd walk you guys through it so you can better understand how to use this tool. This budgeting tool is brought to us by Freddie Mac. You're going to learn a little bit more about Freddie Mac and Fannie Mae later on in tonight's class. But let me walk you through this example, and then we can see kind of what this looks like. This is going to start with a baseline rent price, and then we're going to look at various sales prices. So I do realize we're in different parts of the country and we all have maybe different goals from a home ownership perspective. So I would encourage you to take some time to use this calculator and see what it looks like for you. But let me just kind of give you some kind of rough numbers based upon what we have in the calculator so far. For time purposes, we've kind of pre-filled everything in. So let's assume we have a rent payment of $1,750 with this calculation. We have renter's insurance of $15 a month. And then we're going to make the assumption that our rent payment will kind of elevate about 5% on an annualized basis every time maybe I decide to renew my lease, okay? And then from the next tab is going to be from a home purchase perspective. If I was to buy a $400,000 house, right, you're going to learn a little bit more about loan programs in just a bit. The minimum down payment to buy a $400,000 house is 3% of your purchase price. That'd also be $12,000. We want to look at what's my tax rate going to be on a house of that sales price, right? Generally, when we calculate property taxes, we're going to use 1.25 of the sales price as kind of the measuring stick for my cost of taxes. Now, depending on where you're at in the country, taxes look a little bit different. If you're in Texas, the tax rate might be a little higher versus the Midwest versus the DMV area. It just depends. But we're going to use as a baseline, usually 1.25%. We have homeowners insurance to insure our house. We have the maintenance costs that we would have for owning my home. So any repairs that come up, we want to bake those into our calculation. We have loan information. So we have a 30-year fixed mortgage. We have an interest rate of 6.5%. That will vary day by day, but we're going to have 6.5 as kind of our starting rate today. Now we have origination charges. Those are charges that a lender is going to charge for financing. Those are also under the closing costs umbrella. Now, one of the great things in our partnership with Maryland is we also pass along a discount to you in those closing costs that APM charges. So we only we have a discount of $750 on our charges. So that lowers that origination cost for you. So any of our eligible alumni have $750 off any financing option we provide. And then discount points are things that buyers can elect to pay as additional costs to help bring down that interest rate. So they're also points are kind of what they're referred to, discount points. What they will equate to in usually 1 point is the equivalent of 1% of my loan amount. So let's say I'm financing $390,000, right? 1 point would be $3,900. And generally that 1 point that I pay will bring down my interest rate about 0.25%. So that's kind of how the math works from a discount point perspective. I'm not a huge fan of discount points right now. And the reason why I say that is because in today's market where interest rates are still relatively elevated, for our buyers that are purchasing in 2024, they're probably going to be looking at refinancing down the road. And generally that'll probably be in the next 2 maybe 3 years, 25 to 26. But the break even on discount points is about 2 years. So not really worth the investment unless we really have to get to a certain payment level. Then we have other settlement services. Those are going to be things like attorney's fees, title, escrow. I would kind of share with you guys, when you're looking at estimates from a savings perspective, to budget about 2 to 3% of your purchase price for those expected costs, also known as closing costs. Okay. And then we also have down payment that we're going to have to save for. We'll talk more about that in just a bit. And then finally, the last assumption we'll make is around the appreciation of the home. So we're expecting the house to go up about 4% annualized. That will vary depending on where I'm buying in the country. How long I'm going to be in the house. We put 7 years. So this budgeting tool is going to compare renting for 7 years versus owning for 7 years. The cost of selling my house, what the state and federal tax rate is. And then finally, we want to measure in what a savings rate could be. Okay. So what this calculator does is it comes back to us and says, okay, well, let's first of all look at our payment, right? We have to have the expectations that if we want to enter the housing market, we're probably not going to be able to spend $1,700 a month in rent if we want to buy at $400,000. So from a housing perspective, that home mortgage payment will elevate. And in this case, it's going to elevate to $3,300 a month. Okay. So we're almost double what we're paying in rent. So we have to factor that into our calculation. Now, the opportunity cost, if we kind of map out 7 years of renting versus 7 years of owning, you have about a $40,000 opportunity over those 7 years by owning versus renting. Now, how do we get there? It's going to be through appreciation of the home. So the home's going up in value. I'm not writing checks for my rent. There's also tax benefits, like we talked about earlier, that come along with owning. Those get factored into the equation of owning a home. So to my point earlier, it's not really an apples to apples comparison when we budget for home ownership. Now, we want to make sure we can afford what we're buying, but not necessarily $1,750 rent will equate to $1,750 as a mortgage payment. Okay. So that's our budgeting tool. We'd love to kind of start our classes with that because I think that kind of helps kind of frame up home ownership a little bit. Now, I want to talk now about the housing market. We're looking at the Maryland housing trends right now. Not really a lot different than what we're seeing across the country. Now, the prices may look a little bit different, but the trends, the inventory levels look fairly similar. Average day on market right now for Maryland homes is just over a month. A lot of that is seasonality in the markets. I know it's still a little bit cold. The sun hasn't really consistently been out. But as we get to the warmer months, the spring and summer months traditionally are your busier months. What will be different this year than 2023 is that we'll have more inventory to work with this year as prospective buyers. Some of the initial kind of projections we're getting for inventory this spring and summer is that inventory will go up 10%, which is encouraging because we definitely need it. We're in a situation right now where there hasn't been a lot of inventory over the last 1.5 to 2 years because a lot of existing homeowners didn't want to trade out their 2.5% and 3% rate mortgages to get into a mortgage that's maybe 7%, right? And so we kind of really stymied ourselves in terms of inventory that's available to buyers. That's kept prices relatively flat, or as you can see in this example, prices kind of been drifting up, right? Only so much inventory, you have buyer demand, that's going to either level out or push up prices. Now, I think the question is going to be is how will interest rates impact home buying this spring and summer? Some early indicators are that we're going to see interest rates potentially come down at the middle of the year, and we say middle of 2024. There is thoughts that the Federal Reserve may lower interest rates in June at the June meeting. The Federal Reserve is meeting, I think, next week. There will be no rate cuts this meeting, but there's a chance that we could see rate cuts in June. And so, if rates do come down, there's two things that generally will happen, right? more buyers will enter the market, but that it could also push prices back up because of limited supply and just demand by buyers. So we're going to really watch that pretty carefully. Where have we been from an interest rate perspective? Well, we've been kind of everywhere. During the pandemic years, we had rates as low as 2.5%. October of 21st of 2023, we reached highs, which you can see on screen, of about 8%. And now today we sit right around 6.7 to 6.8, give or take. Today was a little bit of a rougher day in the markets. Mortgage rates are probably going to go up about 0.125 tomorrow. But it's a very fluid situation. I think long term, the horizon on interest rates look like interest rates will eventually drift consistently to the mid to low sixes. My guess is that in 2025, we'll hopefully see interest rates crack down into the 5% range. But, it's ultimately something that will vary based upon the market conditions. Why we're here, or how we're here from an interest rate perspective, really has to do with inflation. And so a lot of what has happened with our interest rates is the Federal Reserve raising interest rates to combat inflation. Their target number for inflation is actually 2%. We're still a long ways away from that, but hopefully at the June meeting, we'll start to see interest rates start to pull back a little bit. All right, now interest rates aren't the same for all buyers. And I think that's important to understand, because you may talk to, a friend down the street and they say, hey, I got this rate, or your family member got that rate, because the interest rates look a little bit different for every situation. It has to do with credit eligibility, the type of product I'm going to look at, how much I finance, what my down payment is. We talked about discount points earlier. That can influence my interest rate. We don't have on screen, but sometimes you can take out adjustable rate mortgages, which can lower your interest rate. Not in this market, but in some markets it can. And then finally, the term of your loan. So if I shrink my loan down from a 30-year loan to a 15-year loan, generally the lower term loan will give me a lower rate option. Now, we meet with clients one-on-one to design home buying plans, which you heard me talk about a little bit earlier. We're going to figure out what the right scenario is for you based upon kind of your goals and objectives with home ownership. Now, one of those number one things that go into interest rate is credit. And so in our classes that we teach throughout the country, we like to dive into credit, because that's really on a top of mind issue for a lot of our prospective clients. And I think it's important to understand how the mortgage FICO score is calculated. Now, I know many of you in tonight's class have monitoring tools like Credit Karma, or some of the tools through TransUnion, Experian, or maybe even Equifax. But I think it's really important to understand how the weighting works with the mortgage score calculation. So we have it on screen. 15% is going to be the length of my credit. So the more mature my credit file is, potentially the higher my credit score is going to be. Now, 20% is going to be how much new credit am I trying to open? So how many new accounts am I trying to open? And also, what do those inquiries look like that I'm trying to make on my credit report? We're looking specifically at hard inquiries. Those are where you're going to have an impact to your score. Now, there's a credit rule in place for hard inquiries, which is if I apply for auto financing or mortgage financing, I have a 30-day window of time to apply with as many mortgage lenders as I want. And it's the equivalent of one credit inquiry hit to my score. Okay, so just kind of keep that in mind. Now, with our process, with our team, we only start with a soft credit check. And the reason why we have that approach is because many of our buyers are on kind of long-term plans, right? They're not probably buying next weekend or maybe even next year. So we don't want to damage their credit. So we want to help give them a plan without having the impact to their score. So our consultative process only starts with a soft credit check for now, at least. 30% is going to be credit utilization, amount owed. Those are kind of interchangeable things. But what it ultimately means is we're looking at revolving credit, your revolving credit limits versus your revolving credit balances. The optimal level of utilization is less than 10%. I do realize that we have expenses and maybe we might be a little overextended, so our utilization's higher, right? If you're at 80% utilization, we'd encourage you to try to whittle that down to below 50%. That'll be your next level of improvement. And once you've gotten there and you feel pretty good about your level of credit, we want to work towards 10% utilization. Now, what I would encourage you to do is kind of a tip or a resource to kind of think about as you manage your credit balances, and that is around that utilization. And what you're going to be looking at is and let me kind of just step back for a second. When you have time, pull out one of your credit card statements. So just download your PDF file of your credit card statement. Take a look at two dates. There's a billing cycle close date. There's also a due date, right? Now, the billing cycle date is the date when a credit card issuer sends out your payment information, account information, I should say, out to the credit agencies. So all three of them, they'll report your balances, if you know what your balance to credit limit ratio looks like, how you paid your bill, all that stuff, right? The due date is when you have to at least have your payment to the credit card issue. Now, many of us may be in the habit of paying on your due date. Nothing wrong with that. But if you could change that to start paying your credit card before paying it down before the billing cycle date, then you're going to have a balance that's much more reduced. So when the credit card issuer sends the information to the agencies, you'll have hopefully a lower credit utilization, and that'll help lift your credit score. Especially as you're preparing for a major purchase like a home, we would really encourage you to kind of use that method. Last weighting is going to be payment history. That's pretty self-explanatory, right? How have I paid my bills? That's 35% of the weighting. If you've had some past late payments, it's going to be rated as 30-day late, 60-day, and 90-day lates. More severe on the spectrum my late is, the bigger impact I'm going to have to my credit score. With the credit modeling, it's generally going to give more weighting to events that have happened in the last 12 to 24 months as it relates to the impact to your credit score. Okay. Now, every loan program has a minimum credit score. We have them on screen. We're going to talk more about loan programs in just a few minutes, but just know that to use a particular loan program, it will have a minimum credit score. And as a lender, we always take the middle credit score of all three agency scores. Here's an example of that. If my top score is 740, my middle score is 720, my lowest score is 700, we're going to use 720 as the score for qualifying purposes. That's going to impact my program offering, my interest rate. Maybe I have mortgage insurance because I'm putting less than 20% down. So I'll use that 720 credit score. Now that's if I just apply in my name only. Now, if I have a partner that's going to apply with me as well, and let's say my partner scores are 700, 680, 660, well, the 680 score is the lowest middle score between the two of us. So that in turn would be used as my score for interest rate, mortgage insurance, and product offering. So things that we want to be mindful of as we kind of strategically build home buying plans. Account closure, I want to kind of touch on that before we move on. Account closure has to do with closing out revolving accounts. You want to be really careful with that because when you close out a revolving account, you do two things. One is you pull away history and maturity from your credit file, right? It also could impact utilization because now you have one less credit limit that's available to you in the aggregate total of your utilization. So just be careful that you don't close out an account that's been a long-standing account because it could have a negative impact to your score. Now when we look at like past challenges, more importantly, like negative items, this is how long they'll typically stay on your file, your credit file. As I mentioned earlier, it's in the most recent 12 to 24 months, it's going to have the biggest impact to your score. So if I have a collection from 7 years ago, it's probably not going to really hurt me as much as a collection that just popped up on my credit report in December, right? So, but this is how long it'll stay on your report. So if you're kind of curious that maybe I had a late payment on a student loan 4 years ago, how much longer is that going to stay with me? And as you can see on screen, it's about 7 years. Let's talk a little bit about student loans. I know, student loans are in repayment. Federal debt is in repayment. There also is some cancellation of student loan debt coming. Hopefully you're one of the lucky ones that's going to be receiving, some correspondence on that. But regardless, until that cancellation comes, and you plan on buying anytime soon with home financing, we do have to factor in a minimum student loan payment. If you're in an income-based repayment amount, that's the amount we use for qualifying purposes. If you're back in school or if you're on some type of forbearance program still, we still have to count a minimum payment for qualifying. So on the conventional loan program, which we're going to talk about in just a minute, the conventional Fannie Mae loan, we by default take 1% of the balance as the monthly payment. If you're looking at an FHA loan, it's always 0.5% of the total balances. Income-based repayment is generally going to be the lowest option. We have an example of it on screen. So, if you had $75,000 worth of debt, the IBR payment's $250. That's what we use for qualifying versus, 1% would be $750. So we'll kind of help walk you through that during a session with us. But certainly student loans are things that will come up. Just a reminder again, if you're in a deferment right now on your student loans or forbearance, we still have to count a minimum payment if you're qualifying today for a home mortgage. Okay, now I gave you a lot of info so far. We're going to talk about loan programs in just a bit, but before I do, Any questions from our audience? I haven't seen any pop in the Q&A yet, but any questions I can help answer for the audience? Okay. I think we're good, but if you do have questions, again, I'll answer those for you on air, and we'll keep it moving here. So let's talk about loan programs, and these are kind of 5 of the core loan programs. We're going to talk more deeply, I guess, on the conventional and FHA products, but I want to give you kind of a high level look at each one of these loan programs. The conventional loan I've mentioned a few times this evening, that's the Fannie Mae and Freddie Mac loan product. Minimum down payment for first-time buyers is 3%. Goes up to a maximum loan amount of $766,550. Now, I noticed in the chat we didn't have anybody joining us from like high cost of living areas, but there are also higher loan amounts available for high cost of living markets. I guess we could all argue that we live in a high cost of living market, but specific for Fannie Mae and Freddie Mac, there are higher loan amounts that you can go to. So if you happen to be in California, the maximum loan amount is 1149. So there's higher limits that we can go up to on the conventional loans. The conventional loan product has a minimum credit score of 620. And the higher our credit score goes, obviously, the cheaper our interest rate offering is, possibly the lower our mortgage insurance rate would be. And then for FHA loans, that's going to be for clients that are electing a government insured loan. So FHA stands for the Federal Housing Administration. Minimum down payment on an FHA loan is 3.5%. Maximum loan amounts will vary by county that you're going to purchase in. If we're looking in the DMV area, maximum loan amount with FHA loans are $498,257. A lot of people get FHA loans confused as just first-time buyer programs, which are just not the case. We have second and third-time buyers that utilize FHA. The one thing I would just share with you with FHA, it's going to give a lot more flexibility or leniency from a qualifying perspective. Credit scores go down to 580 for FHA. And if we've had past challenges, we'll have a little more flexibility from a credit perspective as well, too. We had a question pop in the Q&A. I just want to kind of answer this really quick. The question was, if I decide to pay off my student loan debt, will that negatively impact my credit score? So installment debt can be a little tricky. Like if you go pay off an auto loan or a student loan or a personal loan, what I've found in my review of hundreds of thousands of credit reports is that generally the installment debt, once paid off, it'll probably lower your score a couple ticks in the first 2 months. But the score will kind of bounce back. So, it's not a bad thing to pay off those debts, but we've just seen it kind of decreases the score just slightly. And then I'll just kind of repeat this. This is kind of a question that's popped in. If you're applying as a couple, do we handle that differently from a financing perspective? So if you're applying individually versus as a couple, does it looked at any differently? Answer is no. So you can apply jointly as unmarried individuals, as married, domestic partnership, whatever the case. I do get that question a lot, is can I apply with my partner even though we're not married? And the answer is absolutely. So it changes things from a legal perspective in ownership of the home, and it depends on what state you're in, but there's no impact from an eligibility perspective. Okay, now the next product is our VA loan product, especially in the DMV area. We have a lot of veterans in the area that can really utilize the VA loan. What's great about the VA loan, it's a 0 down payment option. So for the veteran, you could purchase in excess of $1 million and still have a 0 down payment option. If we have any partial disability from the VA, there's a thing called a funding fee with the VA loan product that gets completely eliminated, or you're exempt from that. Generally speaking, as a first-time user of the VA product, and if we don't have any partial disability from the VA, the funding fee is usually 2.3% of the overall loan amount. VA has a minimum credit score of 620. And for the support of our veterans and homeownership, there's a lot of flexibility and guidelines. If we've had past challenges or just things that have kind of maybe diminished our credit score a little bit, we have a lot more flexibility in the VA product. And then the last 2 products on the screen are USDA. You're right, that's the United States Department of Agricultural loan. Allows us to purchase in rural areas that fit the geography profile for USDA product. Also, there's some maximum income limits by household, and you can see the maximum loan amount on screen. A lot of our rural areas could potentially qualify under USDA. And then the jumbo loan is going to have a minimum credit score of 680. Those are for our clients that need a little bit more financing than the minimum loan amounts or maximum loan amounts that we can do under Fannie Mae or Freddie Mac. Now, the down payments are a little bit higher on the jumbo loan. They're 10 to 15%, as well as that elevated credit score requirement. There also is more asset requirements. And what I mean by that is that we not only have to save up for our down payment and our closing costs, but we also need some additional funds in what we call as reserves. The reserves are usually 12 months, the equivalent of our monthly payment. So if I have a $7,000 mortgage payment, I need to have an additional $84,000 in assets that I have access to after I've contributed my down payment and my closing costs. All right, let's talk about PMI. That's private mortgage insurance. I like to just do a quick segment on that just to help kind of give everybody some more information around that. Before I do, I'm going to answer a question that's in the Q&A, which is, are loans different for condos versus single family homes? That's a great question. So for the most part, down payment requirements don't differ on single family homes or condos. And we're going to talk about a little bit later, condos generally have HOA fees or homeowners association dues. So we want to have that kind of in our awareness. Also, if you don't elect first-time buyer programs, and depending on what level of down payment you're at, so if you're at 3% versus 20%, the interest rate offering can look different on condos versus single-family homes. Because Fannie Mae and Freddie Mac, they add in what we call as pricing adjusters based upon the type of property that you have. Okay, let's talk about PMI. PMI comes into play when we put less than 20% down to purchase a home on a conventional loan. For an FHA loan, PMI is required regardless of my level of down payment. So let's talk about conventional loans. There's different payment options for the conventional product. You can elect to do PMI monthly. You can split that up as like half paid monthly, half of it up front. You can completely buy out mortgage insurance, where you, in essence, would have a higher cash out of pocket number to buy out the mortgage insurance. Not a common option at all. And then at times you can elevate your interest rate in order to buy out the mortgage insurance. The most common option that we see clients electing is the monthly mortgage insurance. And that's primarily because mortgage insurance on a conventional loan has a cancellation option that when you reach 2 years and you achieve 22% equity, you can apply to have mortgage insurance canceled. Okay. Now, mortgage insurance on a conventional loan has a few like key characteristics that will actually make up the cost of it. There is the credit score that you have, there's the down payment that you're making, and then how much you decide to finance. So if you've kind of been searching on Zillow or Redfin and you're like, hey, I'm going to do that little calculation there on that website, it's going to probably give you a lot higher mortgage insurance calculation because they're not calibrated to these characteristics of really what makes up mortgage insurance. We'll talk about our mortgage mobile app here in just a second, or later on tonight's class, that you can do some calculations on, but that's where you probably see a little higher number with some of those sites. At the bottom of the screen, you can kind of see what an example would be of mortgage insurance. So if I finance $450,000, I put 3% down to buy my house, I have a 740 credit score, my mortgage insurance is probably about $183 a month. If you did that same calculation on Redfin or a Zillow site, it'd probably be like $350 or $400, just to give you some type of perspective. And then the FHA loan product is another solution, obviously, but the mortgage insurance looks a lot different because there's two forms of mortgage insurance. There's monthly mortgage insurance, which is going to be the equivalent of 0.55% of my loan amount. There's also upfront mortgage insurance, which is 1.75% of my total loan amount. So it kind of elevates the cost of my financing. FHA mortgage insurance cannot be canceled unless you decide to refinance out of the mortgage insurance. So what our client would probably do is use FHA as a short-term solution, refinance into a conventional product. Now, if we look at the FHA PMI example, a little bit different than conventional because we have to stack the upfront mortgage insurance, which would be $78.75, and then the monthly premium is slightly higher at $206. So when you're thinking about those two different product offerings, you may look at FHA and say, wow, that's a lot more expensive. I really want to go with the conventional product. And most clients do, but not all clients will qualify in the conventional loan, especially if I've had some recent late payments. Maybe my credit score is a little bit lower. So as we meet with you to design different options, we'll figure out the right fit for you. But hopefully that kind of gives you some perspective on what mortgage insurance might look like for you. Question in the Q&A, and then we're gonna keep it moving into talk a little bit about income. If you're a couple and you've already used your first time home buyer program, can we still be first time home buyers? So if I'm understanding this right, one of you is a first time buyer, the other one is not, or okay, one of you, yeah. So depends on the state specific program. Most state assistance first time buyer programs, if you're married and one of you is living in the house that you used as a first time buyer, you would not be eligible for first time buyer products. If you're just using a national product, you know, like a Fannie Mae, Freddie Mac loan, and you're a first time buyer, if you're just buying just in your name, you would be considered a first time buyer. But for most state specific products, if you're married and one of you already is a first time buyer and you're living in that house, then you're not really considered a first time buyer. Another question is PMI generally included by all lenders? Wonder if any credit unions, others excluded. It is part of loan financing for every lender, even credit unions. The way in which they construct mortgage insurance might look a little bit different. So they may try to do, like I said, the lender paid mortgage insurance option where they're changing the interest rate down a little bit to buy out mortgage insurance. But mortgage insurance is a Fannie Mae, Freddie Mac requirement. Mortgage insurance, in essence, it's basically insuring the lender for clients that put less than 20% down. It's insuring the lender against default. And then is PMI based on the loan principal or loan plus interest? So PMI is based upon the initial original loan amount. So, you know, there's different factors based upon the credit score, down payment, and amount financed. You know, for example, the factor on a first-time buyer with that 740 credit score, it's basically 0.37% of your loan amount, divide that by 12, and that's how we come up with our monthly figure. All right. Okay, perfect. Let's talk a little bit about documentation. So if I'm thinking about the next steps of homeownership, what should I gather, right, financially? So generally it's the last 2 years of taxes, 2 years of W-2s. If I'm self-employed, I have to put together the last 2 years of taxes because we have to verify that as a self-employed individual, my business has been around for at least 2 years, okay? As a W-2 wage earner, last 30 days of pay stubs. And then from an asset perspective, we'll generally need last 2 months of bank statements, okay? Now, staying within income, I want to kind of just give you a few thoughts around some of the things that we hear from buyers that, you know, are kind of misconceptions, if you will. One is that a lot of buyers, before they start home ownership, they think they have to have 2 years on their job to be able to purchase a home, which is not the case. The 2-year rule applies to having a total of 2 years on your job and or supporting education. So the example I like to give is that, you know, let's say I graduated from Maryland in the fall, but I just started my job the first of the year. Well, I went to Maryland for 4 years, and now I'm graduated and I'm now in my field of study. I'm working in my field of study. Now I would have that 2-year met for the requirement for eligibility. Even if I'm in a situation where I've only been on my job 6 months, but I've been on my previous job 2 years, I've only been on my job 6 months, but I'm still eligible for financing, okay? Now, where the 2-year rule gets a little trickier is if I have multiple employers. Sometimes we see this in the healthcare industry where I have multiple sources of income. Now, in that scenario, I do have to have proof that I've been on both jobs simultaneously for the last 2 years. Now, if I'm self-employed, as I mentioned earlier, I do have to show that I've been on both, that I've had my business for at least 2 years, because we have to develop some type of consistent pattern of earnings for the business. So that's something we'll take a look at. If I have a full-time job, so a 40-hour work week job, but then I maybe drive for Uber or DoorDash on the side, if I want to include that supplemental income, I have to show that both jobs that I've been working on consistently for 2 years, just so I can see that, you know, as a lender, that we've been able to maintain both jobs, right? If I have a part-time job, I have to be on that job at least 2 years to qualify to see the consistency of earnings, because generally part-time jobs will have variability in hours. And then another thing that pops up is on the qualifying side, if I'm going to apply just in my name, right? But I know I have other income in my household because maybe my partner has a job and contributes. If my partner is not going to be part of my application, then I can't include that income as a lender. I only can include the income that shows up from the actual applicant. All right, any questions on income before we go into our debt to income ratio calculation? Okay. Oh, got one. Okay. So for W-2 employees, how do you handle irregular OT since income would be higher than the actual salary? Okay, so great question. So for any variable income sources like bonuses, overtime, double time, shift differential, anything like that, right? We have to see that you've been getting those variable sources for 2 years. So generally speaking, if you have a job, right, you have a 40-hour work week job, but then you have variable pay like OT and bonuses and stuff like that, or commissions, we'll average the last 2 years of those variable sources and then factor that into your monthly salary, right? Okay. Some of our clients, especially in the tech industry in California, there's a lot of restricted shares that clients will get. RSUs is what they're called. Those don't always get factored into the income calculation. They can. There's a calculation we do for that, but those are generally be supported as kind of assets, so to speak. And then the question was, if you're self-employed but have now been full-time at a new job for the last 6 months, what paperwork do you need to start gathering? So assuming we don't have that business any longer, now we've been on the job for 6 months, then we would just need your most recent pay stubs for the last 30 days. If you have a little bit of W-2 income from 23, because 6 months means you worked a little bit in 23, then we would just need to get your W-2 for last year. Most of our calculation will be based on your current pay stub. Another great questions, guys, and we'll take this one last question, then I'll move on to debt to income ratio just to keep us on track. If an individual previously has W-2 income and then transitioned to 1099 for 1 year, would 2 years with both forms of income collectively be sufficient? So great question. So 1099 means you are self-employed, so you're an independent contractor. So if I've transitioned from W-2 to 1099, then I have to have 2 years of 1099 consistent income in order to use that for qualifying. Okay. All right, great questions, everyone. And I'll keep on answering questions, but I want to kind of get you guys to the finish line here, so we'll have some time at the end of tonight's class to answer any more questions that come up. So debt to income ratio is a calculation that we use as lenders to determine eligibility. It takes in consideration your monthly income. For W-2 wage earners, that'll be your gross monthly income versus your monthly outgoing expenses. Generally speaking, we don't want the debt to income ratio to exceed more than 43 to 45% of the pre-tax income. So meaning we don't want your expenses to be more than 43 to 45% of that number. Those expenses will include the things like your mortgage payment, your any type of debts that show up on your credit report, personal loans, overdraft protection, credit cards, student loans, auto payments. All that stuff gets factored into the debt to income ratio. And here's an example of it. So we have, as you can see on screen, PITI, which means your principal, interest, property taxes, insurance. If I bought a condo, we have HOA expenses. And then, of course, if we're putting less than 20% down, PMI. So in this client scenario, we have $2,500 in housing expense. We have $500 in other debts. So that's $3,000 in expenses. We divide that by $8,500 in pre-tax income. Our debt to income ratio is 35.29%. So again, maximum threshold is 43 to 45. We can go as high as 50% for some clients, but obviously that is a high number and probably not very affordable unless there's other sources of income that we're just not documenting. The question I get from the class, our attendees in class is like, what should debt to income ratio be? And that there's varying degrees for clients. Most clients feel pretty comfortable around 33 to 36% debt to income ratio. Okay. All right, our last stop in tonight's class before we talk a little bit about workflow and assistance programs is going to be down payment, right? We've talked about kind of what's needed for down payment and closing costs. We know closing costs are generally 2 to 3% of your sales price. Down payments will vary. Minimum down payment is 3%. But how do we document assets? So generally it's going to be documented through checking and savings accounts if we use those type of accounts. Sometimes you can use retirement accounts, 401ks, 403bs. I would encourage you to talk to your financial or tax advisor before you dip into those assets. Now, if family members want to contribute to your purchase, that is absolutely allowed. For most products, there is no minimum contribution that you have to make as a buyer. You could have a parent that's going to contribute all of your down payment. That's totally fine. But there's a process to how we document that. So generally speaking, gift funds do not need to be seasoned like other assets that you have. We have to document the gift funds by generally a gift letter, and then the donor will transfer that money to what we call the escrow or attorney's account for the transaction. Sometimes we'll need to get statements for the donor, but for the most part, that's kind of how we document gift funds. Now, there's usually two challenges to homeownership. I already talked about one of those this evening, which is credit, right? Because I'm trying to balance credit, make sure I'm on track with bills, or maybe I'm a little overextended. But the other component or the other challenge is generally assets, because maybe we're just getting started out financially. We just graduated, got a new job, trying to get our financial footing right. And that's around assets. So depending on where you're going to purchase in the country, and if you're a first-time buyer that qualifies for certain programs, there's resources in your local communities that can really help you out with home ownership. And so, because we're obviously teaching a Maryland class, I thought we would kind of just dive into the Maryland Department of Housing and Community Development product. But I know there's many of you from all different parts of the country, so we can take some time offline talking about some of those resources. But this will kind of give you some perspective on what some of these programs look like. Most of them are designed to help low to moderate income households. So it's usually low income means I make less than 80% of the median income. Moderate income means I'm probably at 120% of the median income. So in Maryland, there's the MMP First Time Advantage program. You can see some of the characteristics of that program. There's a variety of different options that you can select under that. The difference for each one of those is the more assistance you're going to get. Most programs are going to charge an elevated interest rate. So maybe if interest rates are at 6.8, but I really want to get 5% of my loan amount in assistance, that interest rate could elevate to like 7.5%. So there's a different levels. For time purposes, we won't go over specific interest rates, but I want you to know there are resources out there available to you, as well as the MMP Flex Loan also provides some great resources for down payment and closing costs. So as buyers need those additional resources and support, they are available to you in your local state. It just depends on which product we're looking at. Each state has some form of a housing finance agency. And so that's Department of Housing for Maryland. You may be in Texas and you have the Texas First Time Buyer Program, or I know we have classmates joining us from Arizona. Arizona has their own various programs. So wherever you're at in your journey towards home ownership or location, where there's a first time buyer program that we can help serve you with. Okay, as we get towards the end of tonight's class, I want to talk a little bit about the buying process. So you might live tonight's class and say, I want to know more about my options. I want to put a plan together for the next couple of years for myself. What do I need to be doing next, right? Well, we meet with every one of our clients one-on-one for a video session, and the output of that session is to pre-approve clients to help them on the path towards homeownership. The pre-approval gives a buyer a baseline of eligibility. Usually it's good for 60 days, but especially for a lot of our buyers, they're looking to purchase later on in the year, or it could be soon. But at the end of the day, we can always recertify that pre-approval at any time. And so that's a document that you get. And then if you decide you want to start looking at homes, you have a pre-approval that kind of gives you the range that you should be looking at for your home search, right? We would encourage you to get connected with a realtor to help you in that home search. You're probably going to start most of your search online. You'll create a filter with your realtor of what you're looking for. And then when you find a home that fits all the characteristics that you're looking for in a community or a house, you'll go out and start physically looking at those homes. Now, it may take several months or years to find the right house, but you'll know exactly kind of the parameters of your financing. Now, if you decide to make an offer on a home, that offer gets accepted. Now we're going to move to step 3, and that's called entering escrow. So, and it's called different things in different parts of the country, but collectively it's usually entering escrow. That means you have a ratified agreement with the seller, and now you're going to start this escrow process, which is usually 30 days. So from the time your agreement is ratified with the seller to the time you get a chance to get your keys to the house, it takes about 30 days, give or take, right? It'll vary for different parts of the country, but I would say as a baseline, it's usually 30 days. Once your offer is accepted, you're going to get a call from me congratulating you on the acceptance, talk to you a little bit about next steps, schedule you for what we call a follow-up video consultation, and kind of get things moving on the financing side. Within 2 to 3 days of the acceptance, you'll be expected to make what we call an earnest money deposit. That is usually 1 to 2% of your purchase price. That will also vary depending on where you're buying in the country. And then things like inspections will get ordered on your house. We'll have an appraisal that gets done in your house to make sure the house is worth ultimately what you're paying for it, right? The earnest money deposit, as I mentioned, is usually 1 to 2% of your purchase price. That money will count towards your out-of-pocket expense. I want to kind of backtrack a little bit at the entering escrow phase. So I mentioned to you, We'll reach out to you and obviously congratulate you, but we'll schedule you for a follow-up consultation. What a follow-up consultation does is kind of the opportunity for us to now review your contract, review the up-to-date financing options, make sure that matches for you, and explain your interest rate options at that time and what you're going to be expecting from out-of-pocket expenses, key milestones, and then just kind of get that roadmap in place for you. Okay. Now, in most contracts across the country, there's going to be a thing called a contingency, which allows you to do your homework on the property. We call it, or due diligence, right? You'll generally get a house appraised, you'll get your house inspected, and then of course you'll get your loan approved. That will usually happen in the first 17 days of your contract period. Because as a buyer, we want to make sure you have a sound investment, right? We don't want to make sure that we're getting ourselves involved in some type of money pit. We want to have, a clear idea of what this purchase looks like for you. And that contingency is important because it protects your deposit, your investment in this house until you really decide that you want to move forward. Now, step 4 is going to be processing and underwriting of your loan. We do a lot of the administrative tasks at that time. We'll generally have your interest rate locked in by that time. We verified your employment, we verified your assets, and then we continue that progression into step 5, where we issue your loan approval. That's from an underwriter that kind of is more the credit risk side of things. That at that time, we now know that you're all fully approved. We have your appraisal back at that point in this milestone. And now we start preparing for the closing time period. Now, as a lender, we give you a final closing disclosure at that stage, which creates a 3-day cooling off period before you move to step 6. Before you get that closing disclosure, you will also have the opportunity to sign off on your contingencies. So all those, that review period, as long as you feel like you've done your due diligence and everything checks out, you can sign off on that contingency. And then the closing disclosure gets delivered to you, gives you that 3-day cooling off period before we sign final documents, which will now move us to step 6. And that's where we sign documents in person with a public notary or an attorney, depending on what state we're in. That's an in-person process. Everything up to that point in the process is all done e-signature. Step 6 is still going to be, in-person signing. That usually takes about an hour or so. You'll also deposit your final funds on that same day. And then as a lender, we'll reconcile everything and then wire in your final funds for your financing. That money gets collected by the escrow or attorney office. And once that happens, then documents get recorded with the local county recorder's office. It's called different things in different parts of the country, but it's generally going to be a grant deed that transfers ownership to you, and then a deed for your loan confirming your financing that gets recorded with the county. Confirmations come back. That's now kind of signifying that you're the official owner. And then I get a chance to call you, which is my most enjoyable part of the day, to say, hey, guess what? Now you're the official owner of the home, it's always a celebratory day. So we're really excited about that. Best part of my day, because I get a chance to, pass on the great news. So that's what the path to home ownership looks like. That's our 6 steps of home buying. And hopefully that kind of gives you kind of more of a visual aid on what comes next, so to speak, right? Now, I had a question in the chat before we kind of talk about what's next. So the question is, if you live in a housing market where people are waiving inspections, that we're in Boston, thanks for that, does that impact getting a loan? So it doesn't impact getting a loan at all. So contingencies are optional. So I don't want it to sound like it's mandatory. Contingencies are completely optional, but you do put yourself at risk a little bit if you do waive a contingency, right? Because now you're kind of waiving the right to do your homework. We see that in other markets, not just in Boston. I see it in California, especially in the Bay Area markets, where, you're competing against cash offers, right? And, it'd be great to have a cash option, but for most of us, it's going to be financing. So we want to make sure we have that all in place. But it's not restricted in your financing, to answer your question. All right, so as we're kind of wrapping up tonight's class, if you're thinking about getting on that path towards homeownership, we'd love to be able to be a partner with you on that journey. If you think you're ready to start kind of designing a home buying plan, it's a really simple 3-step process. You have an online application. We only do a soft credit check. You would upload proof of income and assets, and then I get connected with you for a video session. That's a one-on-one with me for about 30 minutes to design a plan. And there is no cost for doing that, so you're not obligated. It's just to help you on that path towards homeownership. Now, a lot of our attendees in our classes have follow-up questions that maybe we're not able to answer on air. If you want to get connected with us for an introductory call, we can certainly do that. There's obviously no cost for that. And this is what a consultation looks like. So this is kind of what we would be expected to cover during that consultation. Where do I want to buy? What's my budget look like? Do I need help with credit? Am I doing the right things from a credit perspective? Do I need to save more money? Do these assistance programs help me? All of those things will be covered in a consultative process. I mentioned to you about our mobile app, so that's available for Android. It's available for Apple. Really great calculators there. You can also start the process, follow different milestones in the process as well too. And then for those of you that might have joined us late, I did kind of spotlight our Maryland alumni discount, which is $750 on your closing costs. So that helps you out either on a purchase or a refinance. And we're super proud of our partnership. We're like basically on year 2 of our partnership with University of Maryland, or kind of 1.5 years, so to speak. And this is our first class we've taught in 2024, and super well attended class. And we have other classes that are available to you, friends or family over the course of the year. We're going to teach over 50 classes in home ownership. So if you want to do a refresher, or maybe listen to one of the recorded versions, those are always available to you. Our whole list of classes are available at mortgageeducate.com. You also have your own dedicated alumni site for mortgage, which is terpsmortgage.com. You'll see a list of your benefits as well as some of our other classes. We have 3 more classes for University of Maryland this year already set up. So, if you want to do a refresh, you're more than welcome to come one of those. Here's all my contact information. So if you want to get connected with me after tonight's class, love to be able to answer any questions you have, be a resource for you in anything you need. And I would encourage you to follow us on some of our social channels. We try to put out good, helpful first-time buyer content. So whether you're buying this next year or 5 years from now, at least you'll get some resources to help you on this journey. And then finally, we love what our clients say about us. We take supporting everyone across the country in homeownership as a big deal. You're trusting us with one of your biggest financial investments you're going to make. So, that's why we teach educational classes like this, but we also love what our clients say about us online. So check out what we have online to offer for you in terms of testimonials. So with that said, we are just before the top of the hour. I got 3 minutes, but I'll be sticking around to answer any questions. I know we've had a lot of good questions throughout tonight's class. I really appreciate your engagement. But I want to open it back up for Q&A. If you guys have some questions I can answer, and then we'll kind of wrap this up tonight. Any questions out there that I can help answer? And thank you for everyone kind of sticking it out. I know I'm the item before dinners for most of you, so I appreciate you spending some time with us before that. All right, I think we're good on the Q&A. Again, if you have questions that you didn't get answered, or you just want to you have a specific scenario, don't hesitate to reach out to me. I'd love to be able to help you answer that for you. Thank you so much for joining tonight's class. Hopefully you found this helpful. And then we hopefully get a chance to get connected with you soon. Have a wonderful evening, and we'll talk to everyone soon. Good night.